What if I told you the biggest story about your rising cost of living isn't the one you're being sold? You hear it all the time. It's because of tariffs on foreign goods. It's those tangled supply chains or greedy corporations. And look, those things can and do cause prices to flicker up, but they are mostly convenient villains in a story that's designed to distract you. The real driver of that feeling, that deep sense that you're working harder just to tread water, is hiding in plain sight. It's a machine that quietly siphons your wealth day after day. That machine belongs to the Federal Reserve. Hi, I'm Luke McCarty with McCarty Wealth, and in the next few minutes, I'm going to show you the one chart that reveals the powerful, often ignored engine behind the inflation that's crushing your budget. Let's start with the official story, the one you get from politicians and news headlines. They love to point fingers at things like tariffs. A tariff is just a tax on foreign goods. The argument is that the tax makes imported stuff more expensive, and that cost gets passed down to you. But in the history of tax rates and in the history of tracking inflation, higher tax rates have never caused inflation. It sounds simple enough, and in a limited way it's true. Tariffs can cause a one-time price bump on specific items, but here's the part they don't want you to focus on. That isn't true, sustained inflation. Inflation isn't just a price shock on a washing machine. Real inflation is when the price of everything, food, gas, rent, services, creeps up relentlessly year after year. It's a steady erosion of what your dollar can actually buy. So if that's not the main story, what is? To get that, we need to talk about something called the M2 money supply. Now, don't let the technical name throw you. It's a pretty straightforward idea. M2 is just a way to measure the total amount of money in the US economy. We're talking physical cash for sure, but more importantly, all the digital money sitting in checking and savings accounts. Think of it as the total pool of dollars available to be spent by everyone. And who's the lifeguard of this pool? The Federal Reserve. Through various tools, the Fed has the ultimate power to expand or contract the amount of money in the system. When you hear people joke about the money printer, and I say this a lot to clients, they and I, myself, we're talking about the Fed creating new money to buy government debt, a process they call quantitative easing. Remember the 2008 financial crisis when Ben Bernanke was the Fed chairman? This changed our banking system from a scarce reserve, where banks used to borrow money from the Fed to meet requirements, to an abundance reserve where the Fed prints money and pays the bank the Fed funds rate on their cash reserves. So this all comes down to the most basic law of economics, supply and demand. If you flood the market with something, its value drops. It works for baseball cards, it works for oil, and it absolutely works for money. When the Fed pumps trillions of new dollars into the economy, but the amount of stuff to buy doesn't grow nearly as fast, you get the classic recipe for inflation. Way too much money chasing the same amount of goods and services. Each dollar becomes less valuable, so you need more of them to buy the same thing. Talk is cheap. Let me show you the evidence. Take a look at this chart of the M2 money supply. For decades, it grew at a pretty stable, predictable rate. But now, look at what happened in early 2020. The line goes nearly vertical. Between early 2020 and early 2022, the US M2 money supply shot up by about 40%. We're talking about trillions of new dollars created and pushed into the economy. This wasn't a minor tweak, it was the most rapid expansion of the money supply since we began tracking this data in the 1960s. So what happened next? Well, for a while, nothing. There's a little known theory in economics about a lag. It takes time for all that new money to work its way into the system and start pushing prices higher. This lag is often estimated to be around 12 to 18 months. Let's check the timeline. The money supply surge peaked in early 2021. Add 12 to 18 months, what happened in the summer of 2022? Almost like clockwork, inflation hit a 40-year high, peaking at 9.1% in June. That's not a coincidence. It's a very powerful correlation that is difficult to ignore. While many economists correctly point out that the link between M2 and inflation had seemed weak for years, the sheer size of the post-2020 monetary explosion brought that relationship roaring back. So what happened after inflation went wild? The Fed, under huge pressure, slammed on the brakes. They started hiking interest rates aggressively, but they also began to reverse the printing press through something called quantitative tightening, the opposite of easing. And look what happened to the M2 money supply. In 2023, for the first time since the data series began in the 1960s, the total amount of money in the economy actually shrank. And what followed this monetary contraction? Again, after a lag, the official inflation rate started to fall. By July 2025, the annual inflation rate was down to 2.7%. The pattern is clear. When the money supply exploded, high inflation followed. When the money supply contracted, inflation cooled, while other factors like untangling supply chains and falling energy prices certainly helped bring inflation down. The connection to the money supply is undeniable, yet it's often the one thing policymakers and financial news seem determined to downplay. But this story isn't over. Recently, the M2 money supply has started to tick up again. While official reports in mid 2025 point to things like housing and services cost as key inflation drivers, the underlying fuel for any future fire is the money supply. So, why should you care about any of this? Because it's the answer to the nagging question: why does it feel like I'm running faster but falling behind? This is a huge part of the answer. Understanding this is the first step to protecting yourself. When a central bank has an official goal of 2% inflation, it's telling you its policy is to make your cash worth less over time. Letting your money sit in a standard low yield savings account is often a losing battle. You lose purchasing power year after year. So here's what we are doing at McCarty Wealth with the anticipation of lower inflation and a Federal Reserve who should and will more than likely lower rates. These stock market sectors do well during falling interest rate environments. Small caps, right? They have cheaper borrowing costs. Small companies need to borrow money to grow. Growth and tech companies, we're staying invested here because they're doing well currently and they do well during lower interest rate environments. And financials, lower rates increase the value of the bank's bond portfolios. Bonds and fixed income, lower rates increase the value of the bonds you currently hold. The exact opposite happens when rates rise. The goal is to move your wealth from something that can be printed infinitely, which is cash, into things that are finite. The next time you hear a politician blaming another country or the grocery store down the street for rising prices, remember that chart. Remember the trillions of dollars created out of thin air. Before every recent inflation report, the headlines have been tariffs expected to cause a rise in inflation. And after recent reports in CPI, it's just not true. The simplified inflation story is designed to keep you looking the wrong way. They would rather you blame anyone except the one institution with the most powerful tools to influence sustained economy-wide inflation, the Federal Reserve. The truth is, your money isn't just losing value, it is being devalued by policy. But now you know where to look. With this knowledge, you are no longer just a passive observer. You can take action. Contact us to get a second opinion on your portfolio and to be part of the investment decisions that we will continually make in order to stay in line and ahead of the Federal Reserve. Check out some of our other videos that include topics like Social Security and the tax law changes from the One Big Beautiful Bill.